Two neighbors, two economies. Canada's housing boom became a debt trap. The US, burned by 2008, rebuilt cautiously. By 2026, their destinies may completely diverge. Let's uncover what really happened and what's next. Most Canadians renew mortgages every 5 years. When rates tripled, payment shocks arrived fast. Debt, not income, drove prices for a decade. Population surged, but housing supply stayed locked. Banks softened the blow, but households remained fragile. Psychology flipped from wealth effect to survival mode. Economists call it a balance sheet recession. When people stop spending to service debt, growth collapses. Most Canadians renew mortgages every 5 years. When rates tripled, payment shocks arrive fast. Debt, not income, drove prices for a decade. Population surged, but housing supply stayed locked. Banks softened the blow, but households remained fragile. Psychology flipped from wealth effect to survival mode. Economists call it a balance sheet recession. When people stop spending to service debt, growth collapses. Money once spent on restaurants, vacations, and new cars is now being redirected to mortgage payments. That cash flow diversion is triggering a broader balance sheet recession. Hundreds of thousands of mortgages reset each month, squeezing household budgets. This isn't just housing, it's macroeconomics. A synchronized payment shock across the economy. When people stop spending to service debt, growth collapses. Psychology flipped from wealth effect to survival mode. There is a way out, but it's technical, not magical. Here are 5 ideas. 1. Phase mortgage renewals. Instead of a massive payment shock, lenders could offer a gradual step up in payments, giving families time to adjust. 2. Reform zoning near transit. Preemptively upzone land along subway and rail lines to unlock millions of new homes where people want to live. 3. Replace transaction taxes with fair holding costs on investment properties to return housing to the market. 4. Encourage productivity. Producing more valuable goods and services is the ultimate escape route from the debt trap. And 5. Restore credibility. Markets reward believable plans. Invest in people and businesses so the next cycle is built on production, not just debt. America entered this rate cycle differently. The 30-year fixed mortgage acted as a shock absorber. Few resets, limited forced selling. Post-2008 reforms tightened credit standards. Underbuilding created scarcity. Wage growth and job mobility sustained demand. Financial rigidity became macro stability. Those who secured mortgages at record low rates are effectively shielded, creating a powerful buffer for household finances. Ninja loans vanished. Teaser rate adjustable mortgages disappeared. Credit quality became paramount. Underbuilding and low-rate lock-ins kept supply tight. Few resets, limited forced selling. Post-2008 reforms tightened credit standards. The housing shortage adds resilience even with higher rates. Three possible paths. Base case, Canada stabilizes, US stays firm. Upside, reforms restore confidence. Downside, renewal shock triggers soft correction. Outcome depends on productivity, policy, and psychology. By 2026, their destinies may completely diverge. Households, stress test renewals early. Investors, chase cash flow, not hype. Policymakers, mix supply reform with credibility. Stability is earned, not gifted. If you found this valuable, hit like, subscribe, and share with someone watching the housing market. Next episode, rate cuts. Why they don't fix housing overnight. What's your take on the housing future? Comment your city below.